Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got, of course, a live show today. We're taking your calls, and when you call that number at the bottom of the screen, you can relay your question to a studio producer, and I'll take your question while you're off air. So again, we do get a lot of questions in a half hour. We only have a half hour show today, so make sure you start calling the number right away. Relay your question to a studio producer, and I'll take your questions live. You know, we're getting a lot of calls, not only obviously on our TV show that we do every Wednesday, but I also do a live radio show for 2 hours on Sunday throughout Florida. A lot of calls coming in from a lot of investors not sure what to do. The advice often they're getting is conflicted advice with a lot of conflicts from annuity salespeople, the bank rep, the broker who's trying to sell you basically what's better for them than what's for your portfolio. And unfortunately, that's how a lot of the business works. I always tell investors this: before you entrust your money to somebody, hire only a fee-only registered investment advisor. We've literally had thousands and thousands of downloads on our website for our fiduciary versus suitability questionnaire. This really will uncover the facts that will really help you make better decisions about not only who you entrust with your money, but about your portfolio as a whole. It's perfect for the pre-retire and retiree. So if you're questioning the advice you're getting, if you're unsure if you have a fee-only fiduciary who has a legal obligation to work in your best interest, or you have the other 90% of really salespeople and brokers who push products that are better for their firm than you, go to my website right now, reznywealth.com. You can download that free fiduciary versus suitability report questionnaire. It's absolutely free. It is a must-read for any serious investor who's concerned about their retirement. Again, I want to talk a little bit about what's going on in the economy and the markets. Every week, when I talk on not only my TV and radio show, I try to really give you a hands-on what we see happening in real life. But what I'm finding a lot of investors are doing is they're basing their decisions on emotion and not a real investment strategy. Unfortunately today, the internet, newspapers, cable TV, regular TV, all these different things have so much hype about what's going on in the economy. The world's coming to an end. We're expecting a stock market crash. All these goofy opinions. Unfortunately, the vast majority of opinions are wrong. So what I always tell investors is this: if you run a strict investment strategy, which includes risk management, I firmly believe not only can you grow your portfolio and get income out of your portfolio, but you can protect your portfolio against those major catastrophic recessionary sell-offs like we saw in 2000 and in 2008. The problem most investors face: they don't have an investment strategy. It doesn't include when to sell, and often you're basing your decisions on opinion and not fact. And unfortunately, that's the crux of a lot of investors' problems. If you have questions about your portfolio, 239-417-4711. Generally speaking, I want to talk a little bit about the month of August and since the beginning of this year. We're seeing a lot of strength, relative strength, and I talk about this often, about relative strength investing, which is really the overall foundation of Rezny Wealth Management and how we manage our clients' portfolios. We use something called relative strength. We look at all investments around the world, not just stocks, not just bond-related investments in the U.S., but all asset categories. We basically pin those asset categories against each other, and we want to own the stronger rising or trending stronger, relatively stronger investment sectors that are doing better versus going down. What we've seen so far in 2013 is primarily the U.S. marketplace, almost dominated by small and mid-cap equities, have really been the leaders. What we're starting to see just of late is emerging market economies and their markets and their sectors are starting to come back a little bit. Let me give you just a kind of an overall view. A lot of equity markets in the U.S. are up around 10 to 15% year to date. A lot of the emerging market economy equity markets are down 10 to 15 to 20% year to date. Big difference. What I think may happen, and we're starting to see this, is equities in emerging market economies are coming back almost as a value point. So what I'm going to say is this: most investors, generally speaking, own what they understand or what they've heard about, which is primarily U.S. investments, whether it's bond related or equity related. That's a huge mistake, because if you look at the U.S., probably less than 10% of the world investments are in the U.S. alone. 90% of other asset categories investments are around the world, and if you don't look at those, you're missing the great opportunities that can not only give you income, but growth and possible asset protection. I'm going to go to my first caller. Dan in Bokeelia. I have a large percentage of my portfolio in a Ginnie Mae, GNMA fund. It has been very painful to watch. Should I sell my Ginnie Mae fund? Dan, great question. We're getting a lot of calls from investors just like you, not only again on my TV and radio show, but into our office every day. We've actually added quite a number of new clients in just the last 2 or 3 weeks because investors are realizing a buy and hold approach is old school, it's ineffective, and that asset allocation where you allocate 60% to bonds, 40% to equities is a huge failed mistake. What I'm going to tell you is this. You're like a lot of bond investors. You overloaded the boat in bonds and you didn't know when to sell. At Rezny Wealth Management, right now in our portfolio, we're in the shortest duration we possibly can for fixed income. In fact, most of our portfolio for the income side of the portfolio is actually in what's called floating rate investments or floating rate bonds. The reason we own those 2 reasons. Number one, if rates slowly move up, which I firmly believe they will, we have protection from principal decline because they're such short-term duration. Floating rate funds typically don't go down when interest rates go up because of the short-term duration. Also, when rates go up, these particular investments, the interest can actually correspond and go up along with it. So we get some asset protection from big downward revisions in the principal because of interest rates going up. And we also get higher interest rates as rates slowly move up. So what I'm going to tell you is this. We don't own any Ginnie Maes now, and I would not recommend people buy these. In fact, if I look at government securities as an overall, whether they're treasuries or Ginnie Maes or muni bonds, these are some of the most overvalued sectors and probably the least reward and the most amount of risk. What I would suggest to you, Dan, call our office, schedule a consultation at our Naples or Fort Myers office. Let's sit down, let's review your portfolio, and we'll show you how a real investment strategy, which includes risk management, or better yet, when to sell, can help your retirement and your income needs for retirement. Mitch in Naples, do you think there's a correction coming? How do you know when to sell? My broker is buy and hold. That didn't work the last 2 times. Mitch, I get that comment a lot from a lot of our new investors that hire my firm. Most investment professionals are brokers with a title. And what they basically do is they sell you mutual funds or annuities or stocks or bonds, and it's basically a buy or hold. And I know what you're saying. My broker calls me every quarter. That's called the relationship phone call. That's not money management. And in a brokerage account, your money's actually not managed at all. You're responsible in a brokerage account, which I can pretty much guarantee probably 90% of our TV listeners today have, but don't know that they don't have an advisory account. So you think your money's being managed when in fact you have a brokerage account and the onus on when to sell is on your shoulders. Again, this is a misconception many investors have. Your broker's a nice guy, but his job's to sell, not to manage. So when to sell an investment, your broker's never going to really know because his job is to sell you more investments, not when do you actually manage the portfolio in order to sell positions that need to be sold based upon changing economic conditions. So at the end of the day, how do we know when to sell? We use relative strength. I talked about this earlier. Not only do we look at the equity markets from around the world and the bond markets from around the world, but we look at currencies and oil and gold, inverse ETFs, and cash and all kinds of asset categories. We put all those categories together and we own the ones that are relatively stronger, earn an uptrend. Sometimes that means we're selling equities or equity-based investments and raising cash. So if cash is performing higher over a rolling 30 and 90-day period based upon our proprietary system, we start raising cash. That helps mitigate big downward drafts in your portfolio and helps preserve your money. When do we know when to rebuy? When we get the same reflection point. So basically when cash is underperforming other assets, Cash is sold, and other assets that are better performer go back into the portfolio. It's not quite as simple as that. Of course, we've been managing money for a long time, but generally speaking, you sell what's weak, you own what's strong, and you want to look at all asset categories, not just stocks and not just bonds. I need to take a short break. Before I do, please go to my website. By the way, we have a new report coming out, How to Avoid the Annuity Ripoff. We have had so many calls from investors and so many questions from investors about annuities and being taken to the woodshed. We're going to tell you how not to be taken advantage of by Mr. Annuity Salesman in a free report. It's going to be available only on my website, and that should be uploaded in the next couple days for all of our TV and our radio listeners. I'll be right back with your calls and your questions after this. Hi, I'm Brian Rezny. If you're like many investors, you've lost a lot of your retirement assets due to poor investment management or being sold investments that are often better for that so-called advisor than you. Most so-called advisors are just salespeople or brokers for investments their firms represent. No real advice at all. If you're tired of bad investment advice and are ready for positive change for your retirement, call my firm for a consultation. Don't settle for bad investment advice. There is a difference. Call us today. Hi, I'm Brian Rezny. We're back. We're talking about the investment markets. We're talking about bonds. We're talking about stocks. Whatever your investment question is, maybe you're questioning the advice you're getting from that broker or so-called advisor, call me in the studio right now. I'll help get you the right answer so you can make better decisions around your portfolio. Don't be sold. Get the right information that's in your best interest. Number's at the bottom of the screen. When you call that number, relay your question to one of my studio producers, and I'll take your question when you're not on the air. Mike in Marco Island. How do I check out my broker and his firm? Great question. If you are dealing with any brokerage firm or an investment person at a bank or an insurance broker, the best thing to do is go to FINRA, F-I-N-R-A, FINRA.org. Check out the firm, not necessarily the broker, because you got to remember, the broker is working under the umbrella of the brokerage firm. The brokerage firm is telling that broker basically what to buy and sell and what to do. The broker is a salesperson being instructed by the hierarchy. What you want to do as an investor is simple. Go to FINRA.org, plug in your brokerage firm name, and let's find out what comes up in the report. Sometimes these reports are pretty disturbing. In fact, I suggest every investor check out the firm they entrust their money to. Has this firm been fined and censured once, 20, 40, 50 times? The scariest thing of all, the biggest firms in the industry, they have rap sheets about this long, meaning some of these documents on what they've done wrong to you, the investor, sometimes are over 1,000 pages in length. You should be reading that and check out so you are not taken advantage of. Check out your broker. Go to FINRA.org. If you're checking out a registered investment advisory firm like Rezny Wealth Management, you would go to sec.gov. And you'd go there to check out registered investment advisory firms. Remember, a registered investment advisory firm is different than a brokerage firm or an insurance agent. So you would check the two different spots. And I firmly suggest you do that. Every investor should. The sad fact is, I would say less than 1 out of 100 people that come into our offices will ask that question, have never done that. So again, check out the firm to protect your money. Walt in Naples. In your opinion, are MLPs worth investing in? MLP stand for Master Limited Partnership. I am looking for growth as well as a decent yield. Do you have any suggestions? I really, at this point on the MLPs or Master Limited Partnerships, I don't have any real suggestions. In fact, I would be avoiding these right now, and I'll tell you why. Investors have been chasing master limited partnerships because they have a higher yield than other income-oriented investments. So when you're looking for growth and you're looking for income, you could look at master limited partnerships, but these things have been just on a tear on the upside. They are highly overvalued. I would really seriously reconsider looking at master limited partnerships, and what I would look at is floating rate income-oriented funds or investments that give a chance to float the interest rate up as rates move up to give you some asset protection from rising interest rates. MLPs, if rates keep moving up the way they have, eventually MLPs will get hit, master limited partnerships, and higher interest rates will affect these. Not to mention, a lot of these are currently trading at nosebleed valuations. It kind of reminds me of 2000 in the tech boom when investors only bought tech. I'm seeing a lot of that with master limited partnerships, and I think there's too many investors who bought too many of these things strictly for yield and don't truly understand the risks they have in a rising interest rate environment. When rates go up, often alternative fixed income investments that are paying higher than normal yields go down a lot. You need to be careful as an investor. This is the time you want to be more conservative and shorten that duration in fixed income, not trying to get the highest return or interest on fixed income because you're going to lose your shirt. Mike in Naples, I'm 25 years old. What is the best way for me to invest my money? Mike, great question. At Rezny Wealth Management, we have client minimums, and our client minimums usually start at $500,000 on up. Occasionally, we do make exceptions. One of the things that we're working on right now is we're getting a lot of calls, and we have over the years, from smaller investors who want to be able to have access to the wealth that we have at Rezny Wealth Management, and they want to work with a fee-only fiduciary firm, not a brokerage firm and not an insurance agent that is selling annuities. Unfortunately, there's not a lot of great opportunities for you, the smaller investor. At Rezny Wealth Management, we're actually working on setting up a special division for smaller accounts so we can help people like you. Until then, what I would suggest you do is visit my website, reznywealth.com. We've got a lot of great information on our website you can listen and learn with. And more important, remember, before you start investing dime one, you need to develop an investment strategy, and you need to follow that investment strategy. Probably one of the best opportunity investments that I would consider for all investors, small and large, are ETFs, exchange traded funds. They're low cost, they're transparent, and they don't have the shenanigans of all these Wall Street investments that have high prices, high internal costs, and basically lack the transparency and are often better for the firm selling them than an ETF is. Look at ETFs. I think it's a great opportunity for small investors and big investors. Low cost and transparency without a lot of the shenanigans you often see in the manufactured products from Wall Street. Alan in Naples. I buy muni bonds for income. They have been going down, but the interest on the funds go up. I know that I lose on the value, but I gain on the interest. What are my thoughts? Alan, I would not own mutual funds right now in the fixed income area, generally speaking, in traditional fixed income. I know what you're saying. Interest rates go up, your value goes down, but you get higher interest. That's not necessarily true. In fact, if you're looking at fixed income, straight fixed income, I almost would do some kind of laddered portfolio. I wouldn't go out any more than 5 years, and I would have 5 years down to 1 year. That would be if you really have to be in fixed income. What I'd rather see you do, Alan, is look at some kind of floating rate fund where the rate floats up and down. This way, it has less impact on the principal, and you have a better chance as rates move up to get a higher corresponding rate. The fact, or the sad fact, I'm going to put it differently, the sad fact is fixed income investors, you're not going to make a lot of money in income the next 3 to 5 years on the income that's coming from these investments. The game has been changed. Interest rates are low, rates will slowly move up, I don't believe fast. At the end of the day, you need to look at other areas to grow and get money from your portfolio, and just putting your head in the sand or in fixed income, I think is a huge mistake, and I'm finding too many retirees are making the mistake believing their portfolio is safe when it actually may be very, very risky based upon the assets they currently own. I'm going to go to a short break. Visit my website at the bottom of the screen, reznywealth.com. We're going to have some great information not only at reznywealth.com for you, but you can sign up for a newsletter. It's free. You can also download for free that fiduciary versus suitability report. And we also have a special report, How to Avoid Outliving Your Money During Retirement. It's a must-read for any serious retiree who wants to get income and grow his or her portfolio. I'll be right back with your calls and questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Do you know the biggest risks to your retirement and investments? One is entrusting your hard-earned money to someone who doesn't work in your best interest. The other is a lack of a detailed investment strategy to meet your goals. Both risks can be devastating, but both can be corrected. Rezny Wealth Management, fee-only money management. Don't settle for questionable investment advice. Call my firm for a consultation. There is a difference. Hello, this is Brian Rezny. Of course, we're into our show today. We're talking a lot about the economy, the markets, and what's really going on. I want to cover a couple quick things, and I think a lot of investors, again, unfortunately, make decisions based upon emotion than fact. Most media outlets hype a lot of things. Market's going to crash. Bond market's doing this. Whatever's happening. At the end of the day, folks, you need to make sound investment decisions based upon a real investment strategy that's in writing that helps you decide what you're doing with that portfolio. I'm finding too many investors making knee-jerk reactions or going to the free steak dinner seminar and being sold the next annuity. That's a mistake. So at the end of the day, before you make a bad investment decision, make sure you do a little research yourself and make sure you know what you're getting yourself into. And one of the biggest problems I see in facing investors today is the nice guy who's selling you the annuity at the steak dinner. Too many investors and retirees are being wrangled into buying these complex investments, whether these are these hybrid or fixed equity index annuities or variable annuities, not truly understanding what they're getting into, with surrender penalties often as long as 22 years. My warning today to you investors is, before you sign a dotted line to buy an annuity, make sure you do better homework, because once you get into these products, it's real hard to get out without a substantial loss on a surrender to get your own money out. That's not right, but unfortunately, there's a lot of the business out there that wants to sell you, the unsuspecting senior, an annuity to line their pockets more than yours. Laura in Fort Myers. My brokers advised me to buy a hybrid annuity as a safe alternative to investing in the stock market, with stock market-like returns without the risk. Is this true? Laura, I wish I had your question before I just made my comment. The person you're dealing with, first off, is an annuity salesperson. He's not an advisor at all. Somebody who sells hybrid annuities, these used to be called equity index annuities, then fixed income equity annuities, then now they're called hybrid annuities. The insurance company keeps changing the name because investors start to get wise and realize these things are generally pieces of junk. First off, equity index annuities or hybrid annuities will never remotely make what the stock market makes, ever, not even remotely close. In fact, from all of our research and all the white papers we've read about these kind of annuities, which are some of the most complex, most expense-ridden, and the most dangerous, in my opinion, for you, the investor, you'll be lucky on most of these products if you make 3 to 4%, 4% being the stretch personally, over the next 20 years. By the way, most of these products, these fixed equity index annuities or hybrid annuities, as they've changed the name, maybe to protect themselves, I don't know, unfortunately have surrender periods that last often as 22 years. So the bottom line is this. These products are designed truly to generate about a 3 to 4% return if you're lucky, and I'd say probably closer to 3. For that, you insanely lock your money up for periods as long as 22 years. For that, when you pull the money out, you pay taxes often twice or double of capital gains tax, because the income on those are taxed as regular income. So at the end of the day, you have an investment that's long-term in nature, that has really no chance to make any real return, that you're going to pay higher tax on. And if you need extra money out of that annuity, you're going to pay a big surrender penalty to get it. First off and foremost, read the fine print, and if you do, you'll run from those annuities and you won't buy one, and I hope you read the information before you put your money on the hard-earned line. Phil in Marco Island. My broker wants me to invest in a non-traded REIT, 20% of my portfolio. What do you think? Phil, and for all my listeners, a REIT is a real estate investment trust. There's two kinds. There's called a non-traded, publicly non-traded REIT. These are ones that you buy and you can't get out of. until they actually sell the assets, which could be 10 or 20 years or longer down the road. These are called non-traded REITs, R-E-I-Ts. The other kind is called a publicly traded REIT. These are ones you could buy today and sell tomorrow. Well, why would your broker want to sell you one that you're locked in for 10 or 20 years? Reason? It's called commission. Brokers love to sell non-publicly traded REITs. The internal cost structure in most non-publicly traded REITs runs often as high as 18 to 22% off the top of your investment. As an example, if you put $100,000 in one of these non-publicly traded REITs, off the top might come as much as 18% of your actual money, $18,000 for all their sales commission fees and everything. You only have 82% of your money in the ground. That doesn't make any sense. Of course, your money is then locked up for 10 or 20-year periods of time. You can get the same value, actually more, by going at publicly traded REITs. These are things that are often traded in the ETF or exchange traded format. They're publicly traded. You can buy and sell them anytime you want with no front-end or back-end surrendalities, and there's no big 18% or 22% haircut when you invest your initial capital. That would be a much better animal for your money. Your broker's not going to show you one of those because they don't make virtually any money on publicly traded REITs. They make a ton of money on non-publicly traded. Remember, your broker's interests are different than yours. Your broker wants to sell what's going to line his firm and his pocket the most. Your interest should be what goes in your pocket. Remember that. Folks, I'm just about out of time. I can't take any more calls today. What I would suggest you do is this. Visit my website at reznywealth.com. You can sign up for my newsletter. It comes out every Monday, and it's free. You can also download our free report, How to Avoid Running Out of Money During Retirement. It's free. You can also go there and learn more about investment advice. Download for free our fiduciary versus suitability questionnaire. At reznywealth.com, you can get a lot of great information without any of the conflicts of annuity salespeople and brokers. Better yet, call my firm for a consultation. If you're unsure what's going on with your portfolio, or you're realizing maybe the advice you're getting isn't really advice at all, call my firm for a consultation. I would love to sit down with you personally, talk about your portfolio, and help better your situation. Our office number is at the bottom of the screen, and also visit our website. Until next week, make sure you have yourself a safe and profitable week.